大家好, we'll explore the 4% rule, living off of dividends, the bucket strategy, and the bond ladder approach in detail. These are the four main strategies on how to convert your 401k and IRA savings into a reliable stream of retirement income. I will discuss the pros and cons of each so you can make an informed decision about your or your parents' retirement income plan. Before we get started, everything I will talk about is for educational purposes only and not meant to be financial advice. And for any mention of specific products and their past returns are not investment recommendations nor an indication of future performance. Before I dive into the details of each strategy, I do want to share an interesting point is that between the bond ladder, the bucket strategy, and the 4% withdrawal rate, they can all end up looking very similar in the end. So it really comes down to your own personal taste with which one you decide to go with. So we'll use an example where someone has $1 million in savings and they are trying to spend $40,000 a year. For the 4% withdrawal rate with $1 million, let's say the person decides to use a 60% stock portfolio and 40% bonds. And what that would mean is that there would be $400,000 in bonds and $600,000 in stocks. Now let's move this over. And when you look at the bucket strategy, oftentimes they would end up having three separate buckets. You'll have bucket 1, which is 1 to 3 year, and then you have bucket 2, which is 4 to 7 year as an example. And then you have the long-term bucket, which is 8 year plus. So the 1 to 3 year bucket is likely to be in cash. And let's say this person has $20,000 in cash. And then the rest of the $100,000 will be in a short-term bond fund, BSV as an example, which is the Vanguard short-term bond fund. And the 4 to 7 year bucket could be an intermediate bond fund like the Vanguard Total Bond Market ETF, and that would be BND. And for 4 years worth of that expenses, that would be $160,000. For the long-term bucket, let's say this person ends up choosing with a 80-20 portfolio, and so that ends up with $140,000 in a bond fund and the rest in stocks. And when you add this up, that ends up being $400K in bonds. So let's move this over and let's look at the individual bond ladder strategy. So if you build a bond ladder, and let's say this person just has two buckets, the bond ladder and then a fully stocked portfolio. And for the bond ladder, the individual investor is choosing to be as safe as he can. So he invests in a 1 to 10 year ladder of Treasury inflation protected securities to really secure himself against future living cost increases. And because each year of his expenses is $40,000, that would be $400,000 in bonds. Again, with the rest, $600,000. Maybe it could be an individual portfolio of dividend stocks. Ideally, it would be more diversified than that. But in the end, when you look at all three different strategies, you got $400,000 in the 4% withdrawal rate, $400,000 of bonds in the bucket strategy, and $400,000 in an individual bond ladder. The individual ingredients may look very different, but the resulting investment pie and investment outcome could look and taste very similar. So now let's dive into the details of each strategy. Investing in dividend stocks can create an income stream that can complement your other retirement income strategies. When selecting dividend stocks, look for companies with a history of consistent dividend growth, strong financials, and a sustainable business model. To mitigate the risk and hassle associated with individual stock picking, consider investing in low-cost dividend stock funds like the Vanguard High Dividend Yield ETF, ticker symbol VYM, Vanguard Dividend Appreciation ETF, VIG, and their international counterpart, VYMI and VIGI. Some of the pros with dividend investing is that it can provide a regular income stream in retirement. It can offer potential for capital appreciation on top of receiving that income, and it can be tax efficient, especially when investing in qualified dividend paying stocks. But the downside is that dividend investing may underperform the market during certain periods, such as when tech stocks were outperforming in 2020 and also in 2023. And focusing solely on the highest yielding stocks can be a trap, as some companies may cut or suspend their dividends. I recall in the early days when I was working at a large broker-dealer, a common stock that was pitched was Seadrill because it was paying over 10% dividend yield. It was a very easy sell for the advisors. But soon afterwards, the company unexpectedly stopped paying the dividends because they weren't making money anymore, and the stock lost 72% in 6 months. And dividend yields alone may not be sufficient to support retirement income needs. As of March 2024, a portfolio equally invested into the 4 ETFs that I mentioned from Vanguard that focuses on dividend investing would have a 12-month yield of approximately only 2.8%. And this further reinforces the point that dividends alone might not be enough. So while dividend stock investing can be a successful way of generating retirement income, it is important to be thoughtful and recognize that it might not be the most suitable primary investment strategy for everyone. One of the more popular strategies for generating retirement income is the 4% rule, which was developed by financial advisor Bill Bengen in the 1990s. The rule suggests that you can safely pull out about 4% of your initial portfolio balance each year, adjusting for inflation, without running out of money over a 30-year period. In the example earlier in the video, I used a $1 million portfolio, and you could draw out $40,000 in the first year. Then in future years, you would adjust that amount for inflation. And to implement the 4% rule, you typically would invest your retirement savings in a balanced portfolio of low-cost index funds. For example, the 60% split to United States and international stocks and 40% in bonds. And the money invested in stocks can provide growth potential, while the bond allocation offers stability and income. So it can be a very good mix. It is important to note that the 4% rule is only a guideline, and your actual withdrawal rate may need to be adjusted based on market conditions and your personal circumstances, especially your life expectancy. So some of the pros is that the 4% rule is very simple and easy to implement. It is a simple calculation at the beginning of the year where you figure out how many shares of stocks and bonds you need to sell in order to raise the 4% withdrawal rate, and you just hold that aside for the rest of the year to use. It provides a guideline for sustainable withdrawals, and historically, based on a study, it was successful in most market conditions. 4% was chosen because even during the worst 30-year period of investment return, 4% still allowed someone to successfully retire. So your withdrawal rate can be higher depending on market outcomes. Some of the cons is that it's mentally difficult to accept spending the same amount of money when the market is down. And it assumes a 30-year retirement period, which might not apply to everyone. And it doesn't factor in variable spending needs, which is typical for retirees who tend to spend more money in their 60s when they just retire, then their spending settles down in their 70s and 80s, then picks up again in the last decade of their life when healthcare costs are highest. Another approach to consider is the bucket strategy, which involves dividing your retirement savings into different buckets based on your short-term, medium-term, and long-term income needs. The short-term bucket, it's designed to cover your expenses for the next 1 to 3 years, and you would probably hold cash and short-term bonds. This bucket provides stability and ensures that you have the funds ready for your immediate needs. The medium-term bucket, intended to support the next 3 to 10 years, would invest in a mix of low-cost stocks and bonds index funds. This bucket seeks to balance growth and stability and allows your money to grow while still providing some downside protection. And as you draw down your short-term bucket, you would periodically replenish it with funds from the medium-term bucket. And finally, the long-term bucket is designed for expenses more than 10 years away and would focus on growth-oriented, low-cost stock index funds, or however much risk you are able to tolerate. And this bucket has the longest time horizon and can afford to take on more risk in pursuit of higher return. And as you move closer to needing the funds for your long-term bucket, you can gradually shift some money into the medium-term and short-term bucket. And you can mess around with the timing. So during periods of market outperformance, you can sell a larger chunk from the long-term bucket and kind of supersize the medium-term and short-term bucket and to feel really secure. But some of the downside of this strategy is that it can be complex to set up and manage, and it requires periodic rebalancing and replenishing the various buckets. And it may not be as tax efficient as other strategies because it's more difficult to utilize strategies like asset location, where you put the higher taxed investment assets in your traditional IRA and Roth IRA, and more tax efficient assets like your broad market stock index into a taxable account. But the bucket strategy does do something a little better than the 4% rule, is that it really gives the investor a sense of security knowing that they have the money set aside. And a similar approach to that is the bond ladder. This approach involves investing in a series of individual bonds or bond ETFs with staggered maturity dates. And for instance, you might invest in a bond maturing in 1, 2, 3, 4, and 5 years, and as each bond matures, you can use the proceeds to cover your living expenses or reinvest into a new bond at the end of the ladder. This bond ladder strategy provides a predictable income stream, as you know exactly when each bond will mature and how much you will receive. Now, some financial talking heads believe that by staggering your maturity dates, a bond ladder just negates interest rate risk, but that's really more a illusion than anything else. But it does help the retiree feel very secure and may allow them to have a stronger stomach to take on risk in the money outside of the bond ladder. It is worth noting that the bond ladder strategy may require more active management compared to the 4% rule or bucket strategy, as you'll need to monitor and reinvest maturing bonds. However, for those who prefer a more predictable income stream, the bond ladder can be an effective approach. So some of the pros to this strategy is that it provides a predictable income stream and it can be customized to the individual's needs. The bond ladder doesn't have to be 10 years, it could be 15 years, or it could just be for 5 years, depending on your risk tolerance. And finally, for a retiree who is too conservative and risk averse, having a bond ladder already set aside for the next 10 or 15 years of their retirement income needs may allow them to actually stomach the necessary risk in the stock market to help fight inflation over the long term. And the downside of this is that it requires more active management and monitoring. And for those who are only having all of their money in a bond ladder, it might not provide as much growth potential as a more balanced approach. And individual bonds may be less liquid than bond ETFs. Fortunately, there are target date maturity bond ETFs from companies like iShare that have a diversified and relatively low cost ETF that invests in a diversified mix of bonds, and they mature at a specific date. None of the 4 strategies I mentioned are mutually exclusive. You can mix and match to come up with an approach that works for you. Because just like dieting, the retirement income strategy that will get you the best outcome is the one that you stick with for the long term. Now that you're generating income in retirement, remember that taxes can be your highest expense in retirement. So I'll talk about that in future videos. So make sure to like and subscribe. Thanks for watching. Jarkin.